Ladies and gentlemen, good day, and welcome to the Man Industries Q4 FY26 earnings conference call hosted by IIFL Capital Services. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prateek Singh from IIFL Capital Services. Thank you, and over to you, sir.
Thanks, Eric. Good afternoon and welcome everybody. On behalf of IIFL Capital, we invite you to Man Industries India Limited 4Q and FY26 earnings conference call. From the management, we have Dr. Ramesh Chandra Mansukhani, Chairman, Mr. Nikhil Mansukhani, MD, Mr. Sandeep Kumar, CFO, Mr. Rahul Rawat, Company Secretary, and Mr. Vijay Gyanchandani, DGM, Investor Relations. So without any further delay, I will now hand over the call to the management for their opening remarks. Over to you, gentlemen.
Thank you, and good evening, everyone, and a warm welcome to our Q4 and FY26 earnings call conference. Let me begin with a moment of perspective. FY26, in my view, has been the most consequential year in Man Industries history, not simply because of the financial numbers we delivered, but because of what those numbers represent. This was the year we achieved our highest ever standalone and consolidated EBITDA and PAT margins simultaneously. This was the year we closed our first international acquisition, a landmark that fundamentally transforms the scale and geography of our businesses. Let me take you through each of these. Firstly, the acquisition NPC, National Pipe Company in Saudi. I want to share exactly what we have acquired. NPC is being acquired for a cash deal of $102 million. And this is including NPC carries a $83 million cash and liquid assets on its balance sheet at the time of acquisition. In this acquisition, we acquired a 430,000 ton running plant, which has LSAW and SSAW both, API certified, Aramco approved, fully operational and dent-free, profit-making pipe manufacturing business, upgraded with approximately $40-50 million in 2017, and with all German and Japanese machinery, and backed by a 2-decade Aramco relationship, and carrying an order book of for FY26 approximately $120 million. The acquisition was announced on 21st of May 2026, executed through our wholly owned subsidiary in Saudi for a total of 102. The funding structure is $70 million through debt, and the remaining $32 million is through our internal accruals. This entire debt will be sitting under the KSA subsidiary with no direct debt on the standalone balance sheet. Our Saudi subsidiaries are independently capable of servicing the acquisition debt from the NPC's own cash flows. We acquired NPC at a 1.5 by EV by EBITDA, a fraction of the Saudi listed peer multiples of 7 to 10 times of the transaction in EPS accretive from day one. Now, a lot of you would be asking how we acquired an asset this quality at this valuation. Basically, NPC's previous owners, 52% were Nippon Steel and Sumitomo. And as we all know, Nippon Steel and Sumitomo are investing heavily in the US, and their core business is into steel. And at the right time, at the right opportunity, we keep buying a lot of raw material from them. And they offered us this asset with all its reserves as well as the order book. And we took it as a great opportunity, and that's how, due to our old relationship, we managed to pull this deal through. Beyond NPC, we are also investing approximately $40 million to develop the pipe coating facilities in Middle East and Daman, and commissioning targeted by mid of 2027. The facility will have an annual coating capacity of 4 million square meters, with an asset turnover 1x and EBITDA margins of between 25 to 35%, depending on coating type, making it highly capital efficient, high margin addition to our platform. The $40 million will be funded through the KSA subsidiary by a mix of debt and internal accruals. Once operational, Man NPC will be one of the very few players in the GCC capable of offering a fully integrated pipe manufacturing and coating solutions from a single platform. A genuinely competitive differentiator for large, time-sensitive Aramco and SWCC projects. NPC's location in Dammam is also one of the Gulf's premier industrial and logistic hub, also gives man a natural gateway to exports to the UAE, Qatar, Iraq, Kuwait, Bahrain, Oman and beyond. The GCC as a whole is also committing hundreds of billion dollars to energy, water, industrial infrastructure, and we are now positioned at its center. The KSA growth trajectory in the near term, our focus is on stabilizing and ramping NPC's utilization, deepening up penetration into Saudi Arabia's water infrastructure and critical oil and gas projects. Saudi Arabia's 80 billion water infrastructure program under Vision 2030 is a massive and largely untapped opportunity water transmission pipes, a large diameter, high specification, and within NPC's product capability. The early traction here could significantly accelerate the revenue ramp up ahead of our FY28 target. At 80-85% utilization, KSA operations have a peak revenue potential of between 3,500 to 4,000 crores and EBITDA between 15 to 18%. A margin profile we expect to sustain for at least the next 3 years, given the favorable pricing environment, tight regional supply, and premium product mix in the Saudi market, with Aramco being at the helm of it. Combined with the existing facility, 1.2 million tons capacity in India, NPC and the Dammam coating facility together transform Man Industries into a fully integrated cross-border pipeline solution platform, one of very few companies globally with this manufacturing scale and coating capability, and client access spanning two of the world's most important energy markets. The order book and FY27 revenue guidance. Our current standalone order book stands at approximately 3,000 crores, executable over the next 6 to 12 months, providing a strong and visible revenue base earning for 27. On the back of our expanded platform, India operations, NPC in Saudi Arabia, and the Dammam coating facility, we are issuing a consolidated revenue guidance between 5 to 5,500 crores for FY27. India would be approximately 4,000 crores, and the remaining would be from the KSA. This represents a significant step up from FY26 consolidated revenue at 3,600 approximate, and reflects our confidence in the combined platform we now operate. I would note this guidance does not include any contribution from Merino Shelters, which is expected to be an incremental earnings driver beginning from Q2 FY27, as the commencement certificate is already received from Merino Shelters. When I look at where Man Industries stands today, over 1.6 million tons of combined capacity across two countries, a landmark acquisition completed, a greenfield stainless steel plant under construction in Jammu, and record profitability, and a 3,000 crore order book, I feel both pride and deep sense of responsibility. Pride because the results reflect the cumulative effort of every member of the Man family, years of consistent execution, sound strategy, and uncompromising commitment to quality. Responsibility because the opportunity ahead of us in India and Saudi across the GCC is the largest we've ever faced as a company. We enter FY27 at an inflection point. The foundations are in place, the order book is strong, and the runway ahead is significant. Our best years are still to come. I want to sincerely thank all our shareholders, banking partners, customers, and every member of our team for their continued trust and support. We remain fully committed to delivering sustained compounding value for all our stakeholders. With that, I hand over to our CFO, Mr. Sandeep Kumar, for the financial walkthrough. Over to you, Sandeep.
Thank you, Nikhil. Good evening, everyone. Let me now walk you through the key financial highlights for Q4 and FY26. Standalone performance. On a standalone basis, FY26 was exceptionally good across every metric. Revenue from operation grew.
I'm sorry to interrupt, sir. You're sounding a bit distant from the microphone. Please come a little closer.
Okay, on the standalone basis, FY26 was exceptionally good across every metric. Revenue from operation grew approximately 11% year-on-year basis to 3,508 crore, while EBITDA surged 49% to 493 crore, with margin expanding 360 basis points to 14%, our highest ever standalone EBITDA margin. PAT grew 43% to 196 crore, with PAT margin improving 130 basis point to 5.6%. Q4 was a particular standout. Standalone revenue grew 36% year-on-year and 44% subsequently to 1,157 crore. EBITDA jumped 69% to 171 crore. Margin 14.6% plus of 300 BPS YOY, with PBT and PAT growing 67% and 74% year-on-year to 95 crore and 70 crore respectively. Now I will come to the consolidated performance. On a consolidated basis, FY26 revenue from operation stood at 3,592.50 crore, with EBITDA growing 31% to 468 crore over our highest ever consolidated EBITDA at record margin of 13%, up to 90 basis point year-on-year basis. Full year PAT stood at 171 crore, up 11% year-on-year. Standalone versus consolidated gap, I want to directly address the notable difference which some investor might have find between standalone and consolidated profitability this quarter, which I know is a key question for many of you. The gap is mainly attributed to forex mark-to-mark effect on capex supplier payable in our subsidiary, which is implementing Jammu project for the stainless steel, and also interest on intergroup ICDs. Two important points to note. This is not a permanent loss. It is a timing adjustment that will reduce and reverse as INR stabilizes. Any residual difference will be recognized in the period the LC are settled in a different non-cash nature. Standalone unaffected. The effect is accounted solely in our Jammu project MSSTL subsidiary. Man Industry India's standalone financials are completely unaffected and appear high as a result. Core pipe business like business growth. One important conceptual point on the consolidated revenue comparison, Q4 FY25, that is last year, included 369 crore of revenue from our real estate business Merino Shelter, which was a one-time recognition which we did as the monetization of our real estate asset, which has not happened in current year. Adjusting to this, our core pipe business delivered like-to-like consolidated revenue growth of approximately 36% year-on-year in QY FY26, a number that accurately reflects the true momentum in the underlying pipeline business. Balance sheet and cash position. We closed FY26 with cash and cash equivalent of 657.2 crore, remaining a net cash positive of 157.50 crore, and generated free cash flow of 132 crore, even after investing approximately 340 crore in capital expenditure during the year. This level of capital discipline and cash generation given us significant financial headroom to execute on our strategic priorities. Some of you must have noticed little increase in our other expenses for the quarter as compared to year-on-year. This was primarily driven by the little change in our business model, which is change from FOB CIF to DDP, where higher freight and logistic costs associated with fulfilling a significant volume of order under delivery duty paid terms. Under DDP, the seller assumes full responsibility for delivery of the buyer's destination, including sea freight, inland transport, import duties, and all related logistic charges, with this cost fully built into the contract price. This is a revenue accredited contract structure. The cost increase is matched by higher realization and does not compress margin on an absolute basis. With that, we are pleased to open the floor for questions.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from the line of Shubham Purohit with SBI Securities. Please go ahead.
Thank you for the opportunity. I hope I'm audible.
Yes, Shubham.
Yeah. So, sir, my first question was regarding the Jammu plant. So what would be the capacity utilization that we are looking for the plant in FY28?
Yeah. You just Shubham, just ask your questions and we'll answer one by one, all your points.
Okay. So the first question was regarding the capacity utilization for FY28 of the Jammu plant. Second is regarding the 300 crore preferential issue that we had done previously. So I had a question if any amount is left to be received from that, or we have received all the amount. And could you also quantify the forex loss that we had faced during the quarter?
Yeah. Okay. So regarding the Jammu plant, for the FY28 for the first year, once the plant starts, is between 35 to 40% of the utilization as per our plan. Regarding the preference got closed out already and in last year itself. And regarding the forex, like we have mentioned, the 25 crores forex due to the equipments, and once that will be recovered once the plant is up and running and the stainless steel plant is up and running, that would be recovered once the plant starts.
Okay, sir. Could I just squeeze in one more question?
Yeah.
So, sir, previously we had a plan for a pipe facility in Daman. So my question is, are we on track for that, or have we scrapped that project given our acquisition of NPC, or is it that we are using that infrastructure for coming up with the coating facility instead of the pipe manufacturing?
Yes, correct. So because we acquired NPC and we got the opportunity, we have continued to just put the coating facility over there and not the pipe. Already NPC has 2 pipe mills, ELSO and ETSO. So we're not putting any more pipe mills, just the coating facility.
Okay. Got it, sir. Thank you so much.
Thank you, Shubham.
The next question comes from the line of Fenil Brambhat with Choice Institutional Equities. Please go ahead.
Hello.
Yes, please go ahead.
I hope. Yeah. So, my first question is on the this revenue contribution. So what percentage of revenue contribution we can expect from the NPC to overall revenue for FY27-28? And also, if you throw some light on the revenue from the real estate segment for next 2 to 3 years. So, and the margins for the same segments.
So, Fenil, for FY27, for NPC, we are looking between 1,500 to 2,000 crores of top line with EBITDA margin approximately 15+%. And for Merino, for 27, 28, 29, we are looking at approximately 70 to 80 crores of profit coming from Merino for the next 3 years. In total, basically, Merino will generate us approximately 800 to 900 crores of top line in the next 7 years.
Okay, got it. And any guidance on the capex for next 2 to 3 years or next FY27-28?
So, Jammu is almost completed, which will be completed FY27, and which is approximately $40 million, which will be also completed by FY27 by March. Yeah. So, that capex of the coating plant will be done by the Saudi company.
Okay. And one more question on this debt raising for this acquisition. So, at what percentage of rate of percentage we are getting this new debt or new this borrowings?
Approximately 6.5 to 7%. At the USD.
Okay.
6.5 to 7%.
Yeah.
The USD.
Oh, in USD. Okay. And can we expect some more additional order book from the Gulf market, considering the ongoing this West Asia conflict and the damage happened over there. So, company is expecting any significant order book in the coming quarter or year
Yes,
from this specific?
we have quite a big bid book, and we are awaiting some of the orders to be awarded. So hopefully in the near future, once we get it, we will be announcing it very soon.
So this 5,000 to 5,500 top line, that includes this expected order book, right?
Yeah.
For FY27? Okay. Got it. Thank you for your answer and all the best for upcoming quarters. Thank you.
Thank you, Fanak.
Thank you. Participants, in the interest of time and fairness to others, please restrict yourselves to 2 questions. For any more questions, you may rejoin the queue. The next question comes from the line of Anant Sarda with Chhattisgarh Investment. Please go ahead.
Hi. Thank you for the opportunity. May I know the reason for the increase in other expenses, like from year-on-year from 350 crore to about 800 crores? And, also what is the nature of business in Taiwan and, in your Dubai branch, right? And also the increase in non-current receivables as well, from 95 crores to 238 crores year-on-year, please. Thank you.
So, hello. As I explained earlier, the other expenses have gone up mainly because of the change in our business model from FOB to DDP. So we are executing all the big orders in Taiwan as well as in Central Asia on DDP model. So all the freight cost, transportation, duty, clearing, logistics, all these costs are getting billed to us, and we are charging it to customer by keeping some margins. So that is the reason of increase in the other expenses. I think I covered this in my speech also. So second question was the increase in other non-current debtors. That is because of some overdue debtors are getting realized in this quarter. We have some amount which will be getting realized in this quarter, and this thing will normalize within next 3 to 4 months.
Yes, sir. But follow up on the first question, sir. Your revenue has not increased. So, as a percentage of revenue, sir?
Revenue is standalone. If you see, almost 37% revenue has gone up in the standalone basis.
So,
I'm talking about
steel prices in the start of the year were at the lowest. And compared to the previous year of FY26, the steel prices were in fact 25% down. And we stocked a standalone last year at 3100 versus 3600 standalone this year. So in fact, after the steel prices going down, we are still up by 20% and the steel difference. So comparatively, we've actually outdone.
Okay, sir. Thank you.
Thank you.
The next question comes from the line of Viraj Mahadeva with MoneyGrow. Please go ahead.
Hi, congratulations to Nikhil, Mr. Garg on the results and more importantly on the astute deal making on NPC. I had 2 specific questions on the NPC acquisition. One is, Nikhil, can you give us a sense as to how we managed to buy this at such a terrific valuation? 1.5 times EBITDA in isolation is extremely cheap. Given the peers, it's even cheaper. So were the sellers, was it a bit of a distress sale? What happened? Was there an auction or were you the only bidder and it was an overnight fire sale that played out? My second question is again regarding financing of the deal. You mentioned roughly 32 million of equity and 70 million of debt. Can you articulate that further to let us know what is the amount of debt that we are taking on the Man India's balance sheet, and what is the non-recourse debt? Presumably this is an LBO at the Saudi level, and what is it at that level? Thank you.
Thank you, Viraj. Thank you for the compliments. Yes, it is a very good valuation that we picked it up from. It was a lot of hard work behind the scenes. The only good part is that we have been dealing with Japan for many years now, and we do share a very good relationship with Nippon and Sumitomo, and we buy a lot of steel for them. This was an opportunity they wanted to exit. They are looking at their core business, which is in the steel industry, and we got this opportunity. We were not alone. There were a lot of ups and downs, but we managed to patiently wait on it, and it took a lot of patience and time. And the good part about the transaction was that when we did the transaction like a lockbox system, all the profit and the business which came from signing the transaction till completion will be remaining in the company. So because of that, we managed to pull off, with a $102 million, with a $83 million almost cash and cash equivalent in the company, and no debts in the company, and with all the permissions. So it fit in right in what we wanted to do by putting a new plant. It fit in much better, and yes, so touch wood, we got a good deal for the company. And regarding the financing, the 70 million is debt, 32 million was self-funded. Nothing on the India balance sheet. It's purely on the asset which we have bought, which is NPC, and the only thing which is India has given a corporate guarantee. That's it, nothing else.
Understood. Fantastic. I'll come back for more. Thank you.
Thank you, Brad.
The next question comes from the line of Divyansh Thakur with Fininterest Capital. Please go ahead. Divyansh,
sir,
please go
actually,
ahead.
I wanted to... Yeah. Am I audible?
Yes, you are.
Hello. Yeah. Sir, first of all, congratulations on a great set of numbers and the acquisition that you have done with NPC. Sir, I am still not able to get my head around that, we had got this company so cheap. We had a relationship with Mittal and Sumitomo that they wanted the exit, but it is quite cheap, and with looking at the cash and cash equivalents on the balance sheet, if you can explain something more, if there were some bidders, why didn't they ask for some more money, or why the valuations are not high? Is there some specific reason that is there, like they wanted to exit? And what is the specific reason that, they wanted to focus on the core business, but they wanted to exit with such a good asset?
So, Divyash, thank you firstly for the compliments. I know it's difficult to digest, but there's a lot of hard work that went behind the work, and it was quite a sensitive transaction for the longest time till the last minute we completed. The Japanese, I don't know if you're aware, are very comparatively straightforward, because they were looking to get out because they wanted to complete, go on in their core business. So that was their main agenda. Also, one more important thing was their style of running the company was quite different because of multiple partners. They were always looking at buying Japanese raw material, and that's why they were losing out also quite a lot of business. They could not ever fulfill the capacity versus the peers who were running absolutely full of the last 3-4 years. If you pick up the balance sheets of the listed companies there, all of them have been doing extremely well, and they've been running at 80-85% efficiency. But Japanese were not buying Chinese steel with their internal conflicts, and we got an opportunity which we grabbed with both the hands, and we came out successful. So that's the best I can tell you what happened. And the good part is that our strategy is to obviously get more business, to fill up and to get all the orders which are available in the market, and go aggressive, and to take our share in the market. That's what we are here to do.
Sir, just the last question from my end that, sir, have we taken this NPC acquisition into our estimates when we have given a guidance for fiscal year 27, or is it not included?
Yes, it is there. 5,500 of the top line estimation includes the NPC as well.
Thank you. The next question comes from the line of Harsh Vaza with SBI Cap Securities. Please go ahead.
Thank you for the opportunity, and congratulations, Professor and team, for fantastic number. So I just had two questions. So the first question was, so what would be the sales volume or capacity utilization for FY26 of NPC, and what will be our overall blended tax rate for FY27 and FY28?
So, Harsh, they have EY. So EY26, they would reach around between 1,500 to 2,000 crores of top line for NPC. And the blended rate would be approximately between 20 to 22%, I guess, would for the 28 and 29, would be approximately 21 to 22%.
Okay. Thank you.
Yeah.
Thank you. The next question comes from the line of Darshil Jhaveri with Crown Capital. Please go ahead.
Hello. Good evening, sir. Thank you so much for taking my question, sir. Firstly, congratulations on the acquisition and a great set of results in Q4, sir. Sir, I just wanted to know in terms of our, the previous CapEx that we're doing in Saudi plant, I thought that we already, have spent some money. So out there, the CapEx, I think, was going to commercialize by Q1 FY27, if I'm not wrong. So what is the status of that? So that is now getting converted into the coated plant, or could you just, help elaborate on that a bit, sir?
Yeah, Mr. Jhaveri, basically the land, all the approvals, the construction permits, and ordering of all the coating equipments has already been done. The infrastructure is being built in place. Originally, yes, we did buy the extra land, but we will have that extra space over there because the lease is very, very low amount. And we would be completing by Q4, FY26-27, we will be completing and operating the coating plant.
Okay. Fair enough, sir. And so just wanted to understand, right now we are in a net cash position and we're going to take, I think, funding for, the NPC acquisition, but that also has cash. So are we going to use that cash, or will we have like a additional finance cost of around 55 CR because of this NPC acquisition on a console level? So what would you feel about the consolidated, interest cost going forward?
We are using the cash for the coating upgrades and the plant upgrades which NPC needs, certain plant upgrades, and this we would be using that cash for that. And certain cash also would be used for the repayment to lower the debts.
Okay, fair enough, sir. And so overall, sir, in FY28, we would have NPC for the full year as well as Jammu and the coating plant. So what kind of growth can we see in FY28? We've given a FY30 vision, but looking at the way we are going, we might be able to achieve that sooner, right, sir? So how would you look at FY28, sir?
So FY28 would be around 25 to 30% growth from FY27.
Thank you. The next question comes from the line of Sandeep with MoneyGrow. Please go ahead.
Yeah, good evening. I have one question regarding order book. So the order book has declined to 3,000 crore and has been trending downward over the last two quarters. Why is this happening? Are we seeing any improvements in new order inflow? And what level do you expect the order book could reach by the end of Q1 FY26? Thank you.
So, yes, the order book, opening order book is, all the executions are going on. So it's at currently 3,000 crores. And hopefully, and we have around a very large bid book currently, which is increased to almost 16,000 crores as we speak. So, and plus NPC. So the order book is, in fact, now much, much larger, the bid book. And we are expecting certain orders which we've been working on since quite a few months. And including in NPC also, we are looking forward for that. So definitely in the next quarter and the next coming few months, there will be more orders in the pipeline.
Oh, thank you. Could you just throw some number, like any kind of range, like?
I can't throw the numbers, Sandeep, but I can give you like the range which I said that we would be definitely achieving the top line between 5 to 5,500 crores for FY27.
Okay, thank you.
Thank you.
The next question comes from the line of Stuti Agarwal with Chhattisgarh Investment. Please go ahead.
Thank you for the opportunity. I just have one question. What is the volume of business that got shifted?
I'm sorry to interrupt, Suti. You're not audible. Could you please change your location a little bit for better coverage? No, it's not.
Okay. Is it better now?
Yes, please go ahead.
I just wanted to know what is the percentage volume of business that got shifted to the DDP model?
For this year, it's almost more than 70%.
Okay. Thank you.
The next question comes from the line of Viraj Mahadevia with MoneyGrow. Please go ahead.
Hi, Nikhil. Thanks for taking my question again. Just wanted to confirm this NPC transaction is completely closed now. Are there any pending approvals? Are any conditions precedent or subsequent to the deal? Also, the financing you've taken at the local level, I'm assuming, is US dollar financing and hence it's cheaper?
Yeah, Viraj, it's completed. We are the official owners. 100% transfer. Everything is completed fully. Nothing is pending. And it's a US dollar loan taken locally from there.
Brilliant. My second question goes back again to the bidding competition. I mean, given that there were other bidders, I'm surprised you still won out at this kind of a bid. And, so that for me is still a little unclear. And secondly, can you guide towards a consolidated interest cost for FY27 on the consolidated P&L?
Hi, Viraj. So,
yeah, hi.
Since we have taken a 70 million loan for the NPC acquisition, and plus we will be completing Jammu project in the coming year. So after completion of everything, I'm not talking about FY27, but FY28, our consolidated cost will be something around 160 to 170 crore.
Understood. So marginally higher than this year, sir, after everything being completed.
But revenue will be also contributing to reaching around almost...
No, absolutely. Absolutely. Yeah. So revenue will be much higher and finance cost will be 10% higher than FY.
I think the acquisition, Viraj, I tell you, it's everyone does feel that we bought it at a good rate, but we lost a lot of time. And that's equivalent to a lot of business. So for me, though we've acquired it at a very good opportunity and rate, I think now looking forward, we need to push and, get the business and the numbers flowing. So I think we were in fact delayed, but it happened and we got the right opportunity and we took it. And that's what, so I'm happy to take the win and now move on to get more business.
Excellent. Good luck. Thank you.
The next question comes from the line of Yash Mehta with Art Ventures. Please go ahead. Yes, please go ahead with your question. Yes, now you are.
Yeah. So I just needed one clarification, sir. So the Saudi project of 3 lakh MTP of EXO capacity, which was going to be commercialized in Q1 FY27, is that still on, or is it scrapped because of the NPC acquisition?
No, it's not. It's scrapped because of the NPC acquisition. NPC itself has almost 430 to 450,000 ton capacity. So then we did not need to go and put a greenfield.
Only coating.
Okay, all right. Thank you.
A reminder to all participants, you may press star and 1 to ask a question. The next question comes from the line of Ajit Sethi with Eco Quantum Solutions. Please go ahead.
Yeah, thank you for the opportunity. So what is the amount of capex we have spent in FY26 and what will be going to spend in FY27 and 28?
In year 26, we have spent around 340 crore on the capex. And in the coming year, FY27, we will be completing coating, which is a $40 million. That will be the capex. And Jammu project. So roughly 200 plus 380. Around 580 crore will be the
at a consolidated
level. Total CapEx for this year.
Okay. And sir, in the opening remarks, we said that the NPC operation can generate 3,000 to 3,500 crore at 85% utilization. So when we can expect this utilization to achieve, in which year?
At FY28, FY29. Both the years we should be able to.
Okay, sir. Thank you, sir.
Thank you. The next question comes from the line of Abhishek Jain with Chris Portfolio. Please go ahead.
Congrats for the strong set of numbers, sir.
Sorry to interrupt, Abhishek, you're not quite audible.
Hello, are you able to hear me?
Yes, please be a little louder.
Okay. First of all, congratulations for the strong set of numbers and acquisition of the MPC. Sir, my first question on the standalone front. So just wanted to understand that what kind of the growth we are looking on the standalone front. And what are the key figures of the business? I mean to say that if you can throw some more light on the business, like on the order book and the demand scenario on the India and the Middle East.
Yeah, Mr. Abhishek, the order book currently stands at 3,000 crore standalone level. And looking forward, we are looking at with the console level with India and Saudi, we are looking at a 30-35% growth constantly for the next 3 to 4 years in the company.
So that means that 30 to 35% growth that will continue for the next 3 to 4 years.
Correct.
Right?
Correct.
Just wanted to understand how is the demand scenario in India and Middle East at this point of time, and what are the growth opportunities there?
So currently, like energy sector is quite troubled because of the war, and every country wants to now secure energy for themselves for any such events to come up in the future. So we are seeing a lot of rebuilding and new infrastructure, including in India, which should be coming up in the next, you will see, 6 months. This ramp up will come, and even in the Middle East and all the regions, including MENA, Africa, and Far East, all the countries are now want to be energy supply and energy sufficient by themselves, and so we are seeing a lot of traction worldwide currently in the oil, gas, and the water sector, and we feel that this post the war in the next 6 to 8 months there is a lot of tractions around the world, and we feel including South America, and there are a lot of new businesses coming up, which is also a growing region for us. So I think we are in the right segment at the right time for the next 3 to 4 years to gain the bone of it.
Got it, sir. And sir, on the margin front, what would be the lever for the margin expansion? One thing that would be the better mix and better geography, better product mix and geography mix. And just wanted to understand how much benefit we can get in terms of the synergy, in terms of the operating leverage because of this acquisition.
Yeah, so the advantage of the acquisition definitely adds up to the immediate business which gets added from day one into the company. Number 2 is Saudi itself is a higher margin country. Currently between 15 to 20% EBITDA margins are ongoing due to the demand supply shortfall. So with the acquisition and with the current, we are looking at a constant 13 to 15% EBITDA going forward in the company. And also by adding value-added products like coating in Saudi and stainless steel in India, this we will further push it up. That's the idea. That's the goal.
Thank you. The next question comes from the line of Shubham with Vcast. Please go ahead.
Hi. Just one quick question. Q4 FY26 on standalone level, you have shown 170 odd crore EBITDA, but on a consolidated level, the EBITDA goes down to 144, 145, but there's no addition to top line. What are these additional costs which have kind of taken down the EBITDA by 24, 25 crores? and why have the margins been lower than the last quarter in this quarter?
I think your question, you're asking question about the EBITDA in standalone and EBITDA in the consolidated number, right?
That's correct.
Yeah,
that's the first part of the question.
This is the main part of two, three things which I explained in my opening speech. The interest capitalization on the intergroup ICDs and also the forex loss which happened on account of capex LC which we open forex MTM, that loss.
But why was this not hedged?
Actually, if you look at the scenario of dollar in last 2-3 months, that nobody predicted war and everybody was having a different view that the rupee will become stronger, and all of a sudden this has depreciated. This is the worst performing currency in total area against dollar.
Also, one more thing which is important, that this is related to capex, and capex, a lot of the items were long lead items which were 18 to 24 months. So even if I hedged it at 24 months ago, we did not expect when we bought these long-term equipments for stainless steel. So that is the reason why this impact has come.
So you didn't hedge because this was a 24-month kind of a period for which you opened this?
Hedging of 24 months itself would have come to almost 90 rupees at that time.
Subsidy. It was a subsidy also.
And also it was in a subsidiary where hedging is not allowed.
So, just as a practice, I would suggest that when you're showing consolidated EBITDA, I think the right way to do it is show a business EBITDA, and then these are all non-business losses. Otherwise, people understand that the EBITDA margins have fallen while they have actually grown. For a business perspective, these are like extraordinary losses.
Correct.
From your business perspective.
Or we'll put extraordinary note on it. Yeah. Okay, well noted. Thank you.
Thank you. The next question comes from the line of Harsh Vasa with SBI Cap Securities. Please go ahead.
Yeah, thank you for the follow-up question. So I just wanted to know the depreciation of NPC for CY25. So what was the depreciation for CY25 of NPC?
Yeah, it's approximately $8 million.
$8 million.
Around 72, 75 crores.
Okay. And sir, could you also tell me the sales volume for CY25 if that is possible?
Yeah, you please send an email across to Sandeep Garg and he'll give the needful, the CFO.
Okay. Thank you.
The next question comes from the line of Darshil Jhaveri with Crown Capital. Please go ahead.
Hello. Thank you so much for letting me ask a question again, sir. So I just wanted to, ask a bit about the margins. We are guiding for around 13 to 15%, but this year we've been able to do around 13%, and the NPC business, I think is around 20%, right? So our margins can be on the higher side, right? Like, are we guiding a bit conservatively, or do you see any war impact which can, maybe impact the margins, right? So, and what do you feel about that, sir?
So Darshil, basically, it's a little bit on the conservative side. We have to be slightly conservative looking at the world scenario. Sometimes there is a war, sometimes there is a COVID, unexpected things happen. So we rather guide at a conservative level, which is 13 to 15, which is a good level for us to achieve consistently. And if we are achieving more than that, I think it would be better. So our target is obviously higher, but on the conservative level, I think between 13 to 15 is very much achievable constantly for the company.
Okay, fair enough, sir. And so just wanted to understand, like, due to this war, any shipments have been delayed. So how do we see, Q1, Q2? Usually our H2 is better, but with, the Saudi plant also coming up right now, Saudi acquisition. So how do we see in the mix, going forward, it being there, so?
Yeah, so yes, couple of shipments have been not going to Abu Dhabi, is one of the projects. And luckily we have a split of mixed bag of projects. Only 20 to 25% is going towards the Hormuz. So yes, that is a slight impact. And hopefully, we hope the Hormuz opens up soon so things return to normalcy.
Thank you. The next question comes from the line of Sahil Chopra with KIFS Trade Capital. Please go ahead.
Hello, I'm audible?
Yes, Sahil, please go ahead.
Yes. Hi. Congrats, and thank you for this opportunity. So, I'm curious to know, since how long this discussion regarding acquisition of NPC was going on?
It was on and off for quite some time, but 9 months would be a little bit more, we were closer to each other, but it's been on and off since quite some long time. I can't give the exact timeline.
Okay. And regarding this ICDs, what is the total quantum of ICDs and what kind of rate of interest these ICDs are bearing?
These are the intergroup ICDs. As you know that for the Jammu project, we have promoters given their contribution in the form of equity and the ICD. So this is that interest we are talking about, and that runs at what? 8% is the intergroup interest is charged between the companies.
Okay, and what is the amount?
It will be total. We have spent around 200 crore on the capex. 262 crore on MSTL Jammu project. That is funded by the man industry. That's it. Which compromise equity as well as.
Understood. And yes. So, as per press release of acquisition regarding this NPC, in that EBITDA margins of the entity was around 20-25%. So, why those margins were higher?
The business which they did last year was with Aramco, and they had large order book and they were executing it at that time. So it was slightly higher, and they didn't do any business in the water segment, which is slightly lower, but then obviously you can build your capacity. So they were only doing business with Aramco.
And so going ahead, what kind of sustainable margin? This 15 to 18% range is sustainable range, right?
Yes, correct.
Okay.
Thank you. The next question comes from the line of Vedant with Mass Investment. Please go ahead.
Sir, I wanted to check regarding this home situation. So I believe this quarter may have some impact. So we can cover any shortfall that you had targeted for this quarter in rest of the 3 quarters?
Yeah, we were able to cover with that.
Yes. So this quarter means you are on track for your internal targets, sir?
Yeah, we are on track on our target.
Thank you.
The next question comes from the line of Ajit Sethi with Eiko Quantum Solutions. Please go ahead.
Yeah, thank you for the opportunity again. So as the new EXTRA and ELSO capacity will be coming in the next 2 years, so do we expect any overcapacity kind of situation in the coming years?
No, not really. You mean in Saudi, right?
So if possible, can you please share the demand supply dynamics internationally as well as domestically, if possible?
It's a part of a presentation, but we can share it to you also.
Okay. Thank you.
Thank you.
The next question comes from the line of Viraj Mahadeva with MoneyGrow. Please go ahead.
Hi, thank you for taking my question again. Mr. Garg, regarding the acquisition, what were the costs regarding the acquisition, diligence, bankers, etc., and what is that total cost likely to be, and will it be booked in Q1?
It will be around 2 to 3%, Viraj.
2 to 3% margin or 2 to 3% deal value?
Yeah.
Okay, so about 3 crores, 2 to 3 crores.
$2 to $3 million.
Oh, $1 million. Okay. Yeah, sorry, $20. Okay. Yeah, okay, great. And that will be booked in Q1?
This will be part of the capitalization on acquisition cost. This will go with the acquisition cost.
Yeah. It's all in the books of NPC, nothing from India.
Okay, perfect. Thank you. All the best.
The next question comes from the line of Shubham with Vcast. Please go ahead.
I just wanted to understand from Q1 perspective, how the Saudi business is looking per se. Is it at the same run rate as it was last year? And India, how is it looking? You told about that 2 ships are kind of blocked in the passage, and 20% of the business is coming from Hormuz. So you are witnessing a year-on-year decline, or how do you see the business shaping up in Q1 for both the businesses in India and Saudi?
Yeah, thanks, Shubham. So basically, no, we're not seeing a decline. Yes, couple of ships have been, waiting to go because of the Hormuz. We have managed to send one across to Fujairah, with the clients accepting the pipes in Fujairah instead of Abu Dhabi, so which is good for us. And we do not expect, in fact, Q1 is quite strong, and it's a good growth from the last lot of Q1 quarters. So as well as Saudi, we've just taken over, and currently we are expecting it to do similar levels to last year or slightly below, but it won't be the right time. We've just taken over, so I can't give a very accurate. Probably in the next quarter would be much clearer observation of where we would land in Saudi. But
and the Aramco book is still there, or
Aramco is still going.
The book is
Aramco back-to-back arrangement with Aramco is already there, as well as order book of Aramco is going on. The new order book
that will be taking up the entire quarter, the Aramco order book.
Yeah, it should. Yeah.
And what is happening to the management at the Saudi level? You are taking it over, so the company management, etc., you're changing it, or you're continuing with the same management?
The key managerial people are changed. Some are retained. Most the key managerial people are changed, especially the heads and the SOPs of handling and reporting systems. And the remaining team, which is down the line of production and all of the engineering and everything, is continuing as it is. No changes.
Thank you. The next question comes from the line of Sahil with KIFS Trade Capital. Please go ahead.
Yeah, hi. Thank you for follow-up. So what is the replacement cost of that plant?
1,500 crores plus.
1,500 crores plus.
So plus 24 months, because API itself will take between 6 months to 1 year, and the new equipments would take at least 12 months for deliveries, and then installation. So 2 years, and Aramco approvals, everything. So more than 24 months to 30 months plus 1,500 crores of capex.
Plus land is also.
And do we have to incur any kind of upgradation cost for this plant in next 2 to 3 years?
Yes. We are starting to slightly upgrade. We have a 3-year plan of around $5 million. There is not much requirement, but small upgrades we are starting to do right now. So
$5 million every year.
These are offline upgrades. Doesn't stop the mill.
Understood. So $5 million every year.
No, $5 million for the next 3 years.
For next 3 years, okay. And regarding our real estate venture, this Merino Shelter, so we are saying 7,200 crore will be our part, our share. So this full thing will flow to the bottom line, or we have to incur some kind of operating expenses, something like that?
No, we don't have no expenses on us. Everything is to the bottom line.
Thank you. The next question comes from the line of Vedant with Mass Investment. Please go ahead.
See, how much is the contracted capacity and how much is kind of merchant activity? Because we are hearing that in Saudi, because of pipe requirement, the entities are buying at quite higher price versus what it used to be a few months back. So how we are going to capitalize, and if we have that bandwidth to capitalize on that opportunity in near term?
Yeah, so we are already, we have around 430,000 ton capacity, and we have the capacity available for the new orders and upcoming orders. So we should be able to capitalize on all the upcoming orders, hopefully post the Hormuz or during.
So, sir, what I mean is for next 6 to 12 months, can there be some extraordinary margins because of that situation and which will normalize later?
We hope so, Vedant. We hope so. We hope.
Okay. Yeah. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. On behalf of IIFL Capital Services, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.